A conference room on the 46th floor of a Manhattan skyscraper falls completely silent as the chief investment officer slides a single chart across the mahogany table, and every portfolio manager in the room realizes simultaneously that the numbers do not add up. The chart shows $700 billion in planned capital expenditures by America's biggest technology companies for artificial intelligence data centers in a single year. And next to it, a column showing how much actual revenue those investments have generated so far, and that column is almost empty. This is the moment the AI dream collides with arithmetic, and the collision is sending shockwaves through every stock exchange on the planet. We are in March of 2026, and something extraordinary is happening in the technology sector that most retail investors have not yet fully processed. The biggest, most profitable companies in the history of capitalism are spending money at a pace that makes the dot-com era look like a garage sale, and the returns on that spending are not arriving fast enough to justify the price tags Wall Street has slapped on these stocks. Nvidia just reported its fourth quarter results, and on paper they were absolutely spectacular. Revenue hit $68.1 billion for the quarter, up 73% year over year. Profit nearly doubled to $43 billion. Full-year revenue for fiscal 2026 reached a record $215.9 billion. By any traditional measure, these are numbers that should have sent the stock into orbit. Instead, Nvidia shares dropped more than 5% the day after the announcement. Let that sink in for a moment. A company posts the most profitable quarter in the history of the semiconductor industry, and investors sell the stock. That tells you everything you need to know about where we are in this cycle. The market is no longer rewarding growth. It is punishing the absence of an answer to one very simple question. Where is the return on all this spending going to come from? Microsoft learned this lesson even more brutally back in January when it reported record capital spending on artificial intelligence infrastructure, but its Azure cloud business showed a slowdown in growth. The stock plunged 10% in a single session, wiping out more than $350 billion in market value. That was Microsoft's worst single-day decline since 2020, and Microsoft did not miss its revenue estimates. It actually beat them. But beating estimates does not matter anymore when investors are staring at a company pouring tens of billions into AI and watching the growth rate of the product that is supposed to monetize that investment slow, down quarter after quarter. The contrast with Meta was brutal and instructive. On the same earnings day, Meta surged 10% because it demonstrated something Microsoft could not, which is tangible proof that its AI spending was translating directly into advertising revenue right now, not in some theoretical future. That divergence between Meta and Microsoft was a warning shot that most people missed. Wall Street is no longer buying the story. It wants the receipts. And the receipts for the broader AI industry are terrifying when you actually do the math. According to Gartner, worldwide spending on artificial intelligence will reach $2.52 trillion in 2026. That is a 44% increase from the previous year. The 5 largest hyperscalers, which are Amazon, Google, Microsoft, Meta, and Oracle, are collectively spending nearly $700 billion on data center projects this year alone. To put that in perspective, $700 billion is larger than the entire gross domestic product of countries like Sweden or Poland. It is an almost incomprehensible amount of capital being deployed into one bet. But here is the number that should keep every tech investor awake at night. According to research from Bain & Company, the artificial intelligence industry needs to generate $2 trillion in new annual revenue by 2030 to justify the current pace of infrastructure investment. Even after accounting for AI-related cost savings, there is still an $800 billion annual revenue gap that nobody has a credible plan to close. Let me say that again. $800 billion per year in revenue that does not currently exist and may never exist needs to materialize within 4 years or this entire capital expenditure cycle becomes the most expensive. Miscalculation in corporate history. Jeremy Grantham, the legendary investor who famously called the dot-com bubble before it burst, published a letter in January of 2026 stating that artificial intelligence is, quote, obviously a bubble, and that the chances it will not burst are, quote, slim to none. He compared it directly to the railroad bubble of the 1800s and the internet bubble of the late 1990s. In both cases, the underlying technology was real and genuinely transformative, but the speculative excess built on top of it collapsed catastrophically before the technology matured enough to justify the valuations. And here is the part that makes this particular bubble uniquely dangerous. The very companies buying the most Nvidia chips are simultaneously building their own chips to replace them. 40 to 50% of Nvidia's revenue comes from just 4 customers: Microsoft, Meta, Amazon, and Google. And all 4 of those companies are now deploying custom artificial intelligence chips in production. Amazon has its Trainium chips. Google has its TPU chips. Microsoft just launched its next-generation custom AI chip. Meta announced 4 new custom AI chips and plans to release updated versions every 6 months. The New York Times reported in January that Amazon and Google are actively eating into Nvidia's chip supremacy. This is not a distant hypothetical threat. It is happening right now. Think about what this means. Nvidia's most important customers are also its most dangerous competitors. They are buying Nvidia chips today because they need the capacity immediately, but they are building their own chips for tomorrow. Every dollar those companies spend on in-house chip development is a dollar that will eventually stop flowing to Nvidia. And the market is starting to price this in, even though the revenue numbers still look spectacular on the surface. Meanwhile, the collateral damage from the AI spending arms race is spreading far beyond the chip makers. In early February 2026, the software industry experienced what analysts are now calling the SaaSpocalypse. Software stocks lost over $1.6 trillion in market value in a matter of weeks. The trigger was a combination of new AI tools from Anthropic that demonstrated the ability to replace entire categories of enterprise software, and a sudden realization among investors that artificial intelligence does not just create winners, it destroys existing business models. Salesforce dropped. Adobe dropped. ServiceNow dropped 11% despite beating earnings estimates for 9 consecutive quarters. The logic was brutally simple. If an AI agent can do the work of 10 software subscriptions, why would any company keep paying for all 10? Reuters reported that the sell-off wiped out nearly $1 trillion in the first week alone, and it kept going. Forbes described it as the moment investors realized that AI is not just disrupting old industries, it is disrupting the very tech companies that were supposed to benefit from it. This is the paradox at the heart of the AI trade in 2026. The companies spending the most on AI are seeing their margins pressured by the cost. The companies selling AI tools are undermining the value of existing software. And the companies making the chips that power it all are watching their best customers build competing products. Now zoom out and look at the macro picture, because it makes everything worse. The Magnificent Seven, which collectively account for 33% of the entire S&P 500, have entered correction territory. Bloomberg reported that the group, which includes Nvidia, Tesla, Apple, Microsoft, Amazon, Meta, and Alphabet, is no longer moving as a monolithic block. The era of buying the Magnificent Seven as a basket and watching it all go up together is over. Tesla is down 16% year to date. Microsoft is down 10%. Amazon is down 7%. Nvidia has dropped from its highs and is trading around the mid-180s, down significantly from its peaks. Layer the Iran war on top of this, and you have a toxic combination. Oil above $100 per barrel drives up operating costs for data centers, which consume enormous amounts of electricity. Rising energy costs eat directly into the margins of every cloud computing provider on Earth. Higher inflation makes the Federal Reserve even less likely to cut interest rates, which means the cost of capital stays elevated, which makes every future dollar of AI revenue worth less in present value terms. The Fed is frozen at 3.5 to 3.75%. Traders expect only 1/4 point cut in all of 2026, and it is not coming until December. That means tech companies are financing $700 billion in capital expenditures in a high-rate environment where every borrowed dollar costs significantly more than it did 2 years ago. Goldman Sachs maintains a buy rating on Nvidia with a $250 price target, but even they acknowledge that the near-term risks have intensified. The question is no longer whether AI is real. Of course, it is real. The question is whether the financial returns from AI will arrive fast enough and in large enough quantities to justify the most aggressive corporate spending binge in human history. And this is where the dot-com parallel becomes impossible to ignore. In 1999 and 2000, the internet was unquestionably real and unquestionably transformative. Amazon was real. Google was real. The technology fundamentally changed how humans live and work. But hundreds of companies that bet everything on the internet went bankrupt anyway because they spent too much, too fast, and the revenue did not arrive in time to keep the lights on. The survivors who emerged from the wreckage became the most valuable companies on Earth, but the investors who bought in at the peak of the bubble lost 80, 90, even 100% of their money and waited years to recover, if they ever did. Today, the AI infrastructure build-out shows eerily similar patterns. Massive capital deployment based on projected demand that may not materialize on schedule. Circular revenue, where the biggest customers are also the biggest suppliers. Valuations that require flawless execution for years with zero margin for error. And an investor base that has been conditioned by 3 years of spectacular returns to believe that AI stocks only go up. So what should you actually do with this information? First, stop treating AI stocks as a monolith. The SaaSpocalypse proved that AI creates losers just as surely as it creates winners, and the line between the two can shift overnight. Second, understand that Nvidia is positioned while still dominant is not unassailable. When 40 to 50% of your revenue comes from customers who are actively building replacements for your product, that is a concentration risk that deserves serious attention. Third, pay close attention to the gap between capital expenditure and actual revenue generation. If the next 2 quarters show spending continuing to accelerate while revenue growth decelerates, that divergence will eventually force a reckoning. Fourth, do not confuse a great technology with a great investment at the current price. Amazon, at its peak in 2000, was a great company that became a terrible investment for the next decade before eventually recovering. The same pattern could repeat with AI stocks if the revenue wall holds. And fifth, remember that the market can stay irrational longer than you can stay solvent in both directions. The AI bubble could keep inflating for another year before it pops, or it could start deflating next week. Nobody knows the timing, but the mathematics of $2 trillion in required revenue against current run rates tells you everything you need to know about the eventual destination. We are standing at the point in the AI story where the poetry of possibility gives way to the prose of profit and loss statements. $700 billion is being wagered this year on a future that has not yet proven it can pay for itself. The smartest investors in the world are starting to ask questions that have no comfortable answers, and the stocks are finally beginning to reflect that discomfort. This is not the end of artificial intelligence. It is the end of the free ride where simply being associated with AI was enough to make a stock price go up. What comes next is a brutal sorting process where the companies that can actually generate real returns on their AI investments will separate from the companies that cannot, and the gap between winners and losers will be measured in trillions of dollars. Your job right now is to make sure you are on the right side of that line.